Okay, so let's talk about something that's absolutely critical in the world of finance. You see a company's financial statements and they list all their assets, right? But have you ever stopped to wonder if those numbers are, real? Today, we're diving deep into the rule that keeps everything honest. IAS 36, all about the impairment of assets.
Think about it. A company has a shiny factory, a big-name brand, some amazing new tech. They put a value on it in their reports. But what if that factory is now outdated? What if that brand isn't so popular anymore? Is that number on the page still the truth, or is it just a number? And that is exactly the problem IAS 36 is built to solve. It's basically the ultimate reality check for a company's balance sheet. It forces accountants to hit the pause button and ask a really tough question. What is this asset truly worth today? Not what we paid for it, but what it's worth right here, right now. So here's how we're going to break it all down. First, we'll tackle the big problem of overvalued assets. Then we'll get into the nitty-gritty of IAS 36 itself and its ultimate value test. We'll also figure out when a company needs to run this test, and finally, we'll talk about what happens when an asset fails and why all of this really matters. Let's get into it.
All right, let's start at the beginning. Why do we even need a whole accounting standard for this? Well, let's unpack the core issue that IAS 36 was created to fix.
So, it all kicks off with this key term, the carrying amount. Now, don't let the jargon scare you. Just think of it as the official book value of an asset. Say a company buys a truck for $100,000. After a few years, they've depreciated it by $30,000. That means its carrying amount is now $70,000. Makes sense, right?
But here's the catch, and it's a big one. Just because the books say that truck is worth $70,000 doesn't mean you could actually get $70,000 for it. What if it's been in an accident? What if a new, super efficient electric model just hit the market? Suddenly, that book value is just a fantasy, and that disconnect between the books and reality is a huge problem for investors.
So how do we fix this? How do we close that gap between the accounting number and the real-world value? Well, that's where IAS 36 steps in. It's the official rulebook designed to stop this kind of wishful thinking.
The official objective sounds a little dense, but the idea behind it is incredibly simple and powerful. IAS 36 basically says, hey, a company is not allowed to carry an asset on its books for more than it's actually worth. In other words, you can't say something is worth more than what you can realistically get back from it, period.
So how does IAS 36 enforce this rule? It all boils down to something called an impairment test. You can think of this as the moment of truth for any asset. Does its book value hold up to scrutiny? Let's see. Now, to run this test, we need a benchmark. We need a way to measure an asset's true economic value. And under IAS 36, that benchmark is called the recoverable amount. And this isn't some made-up number. It's a very specific calculation that gets to the heart of what an asset is really worth. So how do you find this recoverable amount? Well, IAS 36 gives companies two options, and they get to pick the best one. Path number one is its fair value less costs of disposal. That's a fancy way of asking, what could we sell it for today after all the selling fees? Path number two is its value in use. This asks, if we keep using this thing, how much cash will it generate for us in the future? The recoverable amount is simply the higher of those two. It's a best-case scenario number.
Okay, so now you've got your two key numbers, the carrying amount from the books and the recoverable amount from the real world. The test is simple. If the carrying amount is higher than the recoverable amount, you've got a problem. And that problem has a name, an impairment loss. It's a huge red flag that an asset is overvalued.
And there you have it, the whole impairment test in 4 simple steps. 1. Find the book value. 2. Find the real-world value. 3. Compare them. And 4. If the book value is higher, you have to write it down. You recognize an impairment loss and bring that number back to reality. It's logical, it's systematic, and it's absolutely essential.
So this all sounds pretty important, right? The next logical question is, how often does a company have to do this? Is it just a one-time thing? Nope. IAS 36 is very clear about when it's time for a checkup. The number one rule is this: companies have to be vigilant. At the end of every single reporting period, whether it's quarterly or annually, they are required to scan the horizon for any signs, any clues that an asset might be impaired.
And the standard even gives a helpful checklist of things to look for, starting with what's going on outside the company. Has the asset's market value suddenly tanked? Did a competitor just release a game-changing new technology? Did the government pass a new law that hurts the business? Any of these external events could be a trigger. But it's not just about the outside world. Companies also have to look inward. Is there physical damage to the asset? Are there plans to shut down the division that uses it? Or maybe the simplest sign of all, is the asset just not making as much money as everyone thought it would? These internal signs are just as important.
Now, for most assets, you only test if you see one of those red flags. But for a few special, high-risk assets, the rules are much stricter. For these, there's no waiting for a warning sign. They have to be tested for impairment every single year. No exception.
And who's the main culprit here? An intangible asset called goodwill. Goodwill is created when one company buys another for more than its assets are worth on paper. It's supposed to represent things like brand reputation, customer relationships, all that good stuff you can't really touch. But because that value can evaporate so quickly, IAS 36 mandates an annual impairment test for goodwill.
So, an asset fails the test and an impairment loss is found. What happens next? And let's get to the bottom line here. Why should any of this matter to you? Let's connect all the dots.
Well, the consequence of an impairment loss is immediate. The asset's value on the balance sheet gets written down. This directly reduces the company's total assets and usually hits the income statement, lowering its reported profit. It's a very public admission that a piece of the business isn't as valuable as it used to be.
Now, for many assets, if things turn around and the value comes back, a company might be able to reverse that impairment loss. But there's one major exception we just talked about, goodwill. The standard is crystal clear on this. Once you write down goodwill, that's it. It can never be written back up. It's a permanent reduction.
And that brings us to the big so what? Why does this matter? Because IAS 36 is all about transparency and reliability. It ensures the numbers you're seeing in a financial report reflect economic reality, not just some historical cost from years ago. It helps you get a much, much truer picture of what a company is actually worth.
So I'll leave you with this final thought. If a company's assets are what it uses to generate profits and grow, if they're the engine of the business, what does it tell you when you see that company reporting impairment losses over and over again? It's more than just an accounting entry. It's a signal about the health of that engine. And that's a signal every smart investor should pay very close attention to.